welcome everybody, and let's begin. I saw some comments about the conference, the FX Street conference. Anybody going to that here? Who's going to the conference this year? Yeah, how you doing, CVJ? We actually met yesterday. Great to meet you. Excellent. So some people are going to the conference. Great. If it's your first time, you're going to love it. I was there. I think it was last year. Great conference. Great thing about the FX Street conference is it's very different than other conferences. A lot of conferences you're just going there listening to lecture after lecture after lecture. The reason why I did it last year was because it's so unique. You actually listen to lectures, but then you have a full day or two worth of trading with these instructors, so you can learn the method and then actually start trading the method. Yeah, it's a great experience if you're able to do it. All right. Today's topic is multiple time frame analysis, the proper way to do that. Very important you do that. If you do it the right way, you can absolutely stack the odds in your favor. But there are plenty of wrong ways to do it, and typically that will lead to handing your accounts over to somebody else who's doing it the right way. So let's get started here, and we'll kind of jump right in. Okay. Now I'm going to start out by showing you I'm going to show you one page here, one slide, and then we're going to spend the rest of the time on the charts. Okay, so let me take a picture of this for you. All right, can everybody see that okay? Should be able to see that picture now. All right, great. So I want to share something with you. This will just take a minute. This is an email that came in to me on Monday, so just about 3-4 days ago, from one of our XLT members, one of our trading members. So Sam, I was in the Sunday Forex session. I led that session. I took the long position on pound Swiss that we reviewed in the class. I took 2 more contracts. I was happy to find myself up $2,800 by 6 a.m. Tuesday morning. Thanks for the great class and for pointing out the setup on pound Swiss, because I usually don't look at any but the majors. Wiley Jones. Okay, take a look at the setup. We had a Sunday session last Sunday, and we identified that the pound Swiss was declining. It was actually right here. This red candle, that is the Sunday, that's the candle that's where price was when we started the session on Sunday. Okay. Now, if we look to the left, we see that we have a drop base rally. Look at the strong rally out of this level, daily chart. Okay. I'm going to give you just a quick kind of 2-minute version of this. Okay. So why did we buy here? Why were we looking to be buyers here? Because price had reached a level where the chart had told us demand exceeds supply. Right? We have our pattern, not rally-based rally, but drop-based strong rally. Okay. That meant, now understand what for newer people, when prices rally away from this level as they did here, understand this can only happen because there's actually a lot more willing demand here than supply. In other words, we have a supply and demand imbalance. Okay, when we scroll over to the right, we came into Sunday's session and price was sitting right there. What did that mean? That mean that a Forex market speculator was coming into the market and making a very big mistake. 2 very big mistakes. The 2 mistakes are this. Number 1, they were selling after a big drop in price and selling right into a price level where demand exceeds supply. Okay, that is not something that you want to do. You will lose consistently according to the laws of supply and demand. So because the odds of prices turning here were so high, because the risk to buy here was as low as it possibly could be, and because we had the reward was pretty nice as well, we buy right here at this black line with a stop below the bottom black line. Okay, and the trade worked out very well for Wiley Jones and others in the group. Today, I'm going to show you exactly how we arrived at this opportunity and others. Okay, let's go back to the chart so we can do that. I wanted to kind of show you a before and after there. Okay, so let's take a look. Yeah, I saw there was some intervention there. Of course, that came in after the trade was entered. Okay, typically with news, that's just going to speed up what was going to happen anyway. Okay. Now remember, we do run through a little probability scoring system. It's pretty simple. But that's how we determine which levels we want to take, and more importantly, which levels we want to make sure we ignore. So let's take a look at the charts here. So I've got the charts back up. You should be looking at the dollar Swiss. Okay. Now the 3 steps that we're going to make sure we do. Remember, the topic today is multiple time frame analysis. So we're always going to start. Now I'm going to do this for the first way we're going to do it is for kind of swing trading, right? Longer term day trading / swing trading. And we want to do this. Step 1, trend. Okay. What is the trend on the daily chart? And you know what? It's as simple as just putting a 50-period moving average or some bigger moving average on your chart. That'll be fine. Okay. All right. Anything like that. And start with step 1 here. You know, what is the trend on the daily chart? That's going to tell us whether we want to, be buyers or sellers. What side of the market are the odds, on our favor. So we want to start there with the daily charts. Here we see that the moving average is sloping down, right? Just take a quick glance at the moving average. If it's sloping down, you're in a downtrend. If it's sloping up, you're in an uptrend. Don't make it too complicated. The big challenge here is to keep things very simple. So, trend is down. That tells us right off the bat we might want to be thinking short position. So, step 1, daily chart. What is the trend? Step number 2. I'm going to quickly go to the larger time frame here. Okay, so step 2 is going to be always to go to the larger time frame, and I'll show you exactly why we do this. Okay, I'll write it in here for you to keep it simple. Go to the larger time frame. Okay, larger time frame demand and supply. Okay, so step 2, go to the larger time frame. If we started with the daily, go to the weekly here, and here we want to figure out where's our larger time frame demand and supply. There's a reason for that. Okay. Very important reason. So on the daily chart, we see we're in a downtrend, right? Okay. So we're thinking that we want to be a seller. But when does every downtrend, for example, stop, end, and where does every uptrend begin? At support and resistance, real support and resistance, which means real supply and demand. If you're not familiar with the term supply and demand as far as trading goes, you might want to review one of my prior recordings. I go over that in detail. Okay. So the reason why we go to this larger time frame is because even though we're in a downtrend on the daily, what happens if we're, where are we in the supply demand curve on the larger time frame? So when we come to the larger time frame, selling short in this area doesn't look too good. Okay. Because look at where we're at. What we want to do very mechanically is come to the larger time frame and mark off our bigger picture demand and supply levels. So when I do that, I'm going to start right here with current price, and I'm going to scroll down and go left until I hit my first drop base rally, which is right there. So once I do that, I'm going to draw in a couple lines like we always do and mark off my demand zone. Okay, and we don't have to be, you can just do it like this. Okay, here's my level. Now when I scroll up current price, let me blow this chart up a little bit. I want to keep scrolling up until I get to my nearest rally base drop, right? My fresh one. Well, pretty fresh. So this is not, I'm not interested in this, drop base drop, right? We want to come up, here's a rally base drop, here's another one up here. Okay? Now this upper one's pretty fresh. We wouldn't expect prices to go through that. That's a pretty solid level. Looks to be a pretty solid level because prices haven't been back to that level yet. Okay? All right. So given, oops, here, let me get the chart. All right, so here's the daily chart. Here's the weekly chart. I'm sorry. I thought you could see all the charts at once when I was doing this. My fault. Okay? There you go. All right, so now we're on the larger time frame of the same market. Okay? So we saw that we're in a downtrend on the daily chart. But even though we're in a downtrend on the daily chart, we need to know where we're at with regard to larger time frame demand and supply. Okay? So you should be able to see the weekly chart now. Okay, let me scrunch this up for you. So step 2, larger time frame demand and supply. Now, when we look at where we're at, we see current price. Are we closer to larger time frame demand or larger time frame supply? Okay? In other words, should we still be aggressively shorting this market? And when we come to that larger time frame, we see that maybe that's not such a good idea, right? Does everybody understand that? Okay, you see how we're much closer to larger time frame demand than we are larger time frame supply. Okay, so given this fact right here of this larger time frame chart, I still want to be shorting in this market, but nowhere near current price. When I go and do step 3, which is actually pinpointing my entry point, I'm going to be looking well above current price, okay? Because I don't want to be selling short anywhere near this larger time frame demand, just like I don't want to be buying anywhere near this larger time frame supply. But the only way I'm going to know that, where I'm at, is if I go to this larger time frame. So now, let's do step number 3. And don't worry, there's only 3 steps, okay? So now you're looking at a chart, an hourly chart. So for step number 3, when we actually go and pinpoint our trade, our entry point, we're going to come to something like an hourly chart. It doesn't have to be an hourly chart. It could be like a larger intraday time frame. Okay. All right. So we're going to step 3. We're going to find our entry point off the smaller time frame. Okay. So now I'm on a smaller time frame, 60-minute chart. All right. Yeah, Ed, I see your question there. When we get down to that level on the Swiss, yes, we'd be looking for a long position. That's why we don't want to look for short positions anywhere near that. So when I get to the hourly chart, I'm just going to scrunch this up a little bit. Well, I'm not going to scrunch it up too much. Let me blow the chart up a little. So now I see current price, right? 104.29. All right. When I look to the left, remember, I want to look left now and find my nearest rally-based drop that is fresh. When we say fresh, we mean a supply level that has not been revisited yet. We want the odds stacked in our favor. So I'm going to start here. I'm going to scroll left. Okay, I come to this congestion area, but that's not really rally-based drop. I'm going to keep going up the price ladder until we get to this. Rally, base, strong drop in price. Just the opposite of that pound Swiss that I showed you we took earlier in the week. I'm going to wrap my supply lines around this to create that sell zone. All right. And I see we're right around 106 on the hourly chart, which is well placed on the larger time frame curve. So now what I've done is we've identified that the daily trend is down. Okay. We're putting some rules to this, some structure. Without rules and structure, I think it's impossible to make money trading. Okay. That's just my opinion, though. Here we go. So we saw that step 1, the daily trend is down. I'm just using a 50-period moving average there. I went to the larger time frame to see where our larger time frame demand and supply levels were, which tells me whether that daily downtrend is likely to end soon or not. And it also shows me where to look for my entry points. So if I'm thinking of shorting because we're in a downtrend, I want to make sure we're shorting far away from that larger time frame demand level. And so when I come down to the hourly chart to pinpoint my entry price, we find that here. Okay. Now, what do we like about this level? Well, what's the best looking thing about this level? Anybody want to throw it out there? What's so good about this supply level up here? Yeah, strong drop. So everybody that answered that has probably been in these sessions before. So nice job there. Okay. Yeah, FID. That's what we're doing now. Okay. All right. So strong drop from this level indicates a big supply and demand imbalance up here. Okay. The other thing that's nice about it is it's well placed on the curve in the larger picture. Let me just go back to that larger time frame. All right. Right here. And if we look at where 106 is, it's going to be right here. Okay. So we're shorting right here, nice and far away from this big demand level, which means we have a nice profit margin on the downside. All right. Now, you may think that hourly level that I just put up there, is kind of far away from current price. That entry is not going to take place for a while. But here's the thing. In the program we run, we have 4 sessions a week, and by putting these types of levels on all, a lot of different pairs, there's always a trade right around the corner. Okay. All right. The key is to looking at, somewhat non-correlated pairs and applying a very high probability strategy. All right. You're still going to get a decent trade count, but, most of your opportunities are going to be really high quality. Okay. So that's kind of our three-step process that we want to focus on when we're doing kind of longer-term day trading or swing trading or even position trading for that matter. All right. Yeah, we're going to look at some other markets too. Okay. Yeah, so if we're going to look at for a buy, we actually, in the Sunday session, we had this level down here. I can show it to you in just a second. Well, let's move on. I think you saw the lines down there. Yeah, so if we're, once we hit that big wiggly demand level, yeah, then we'd be looking to buy pullbacks to drop base rally demand levels. All right, Bill. Let me answer a couple more questions here. SW, I wouldn't say there is. I would say there is no difference. Understand again, if you've ever been heard one of my sessions, when you have some free time, go back and listen to some of the recordings. But I started my career on the floor of the Chicago Mercantile Exchange, handling institutional order flow in the Forex market, and you quickly understand that even though there's so much news involved in this market, that at the end of the day, the movement of price is simply a function of an ongoing supply and demand equation. All right? That means that opportunity exists when this simple and straightforward equation is out of balance. All right? Therefore, if you believe that, then you'll also understand that the most significant turns in price happen in price levels where supply and demand is most out of balance. Okay? What does that picture look like on a price chart? Because at the end of the day, that's all that's going to matter to you. It's right here. Okay, I showed you a trade that worked out from earlier in the week. Here's the next setup in this market, dollar Swiss. All right. So again, keep your focus on the orders and all that. Yeah. So Jason, yeah, I would say we're complete with this one. Then what you want to do here is, again, what we do is, we sell short at the bottom line with a protective buy stop just above the area, and then our targets below. And that's going to be according to your trading plan. Are you looking for, 2-to-1 to your first target, 3-to-1 to your first target? When exactly do you move your stop to break even? Those things are important. Okay. Victor, yeah, you want to find, ideally the levels where your black lines are close to each other. Again, in the program, we spend a lot of time going over a very mechanical way to do this, but I can give you a lot of that here in our short time together. What I'm doing is making sure that the majority of candle bodies are in between the two lines, right? That's where the meat of the order flow is. So when we sell short here, okay, understand that we would be selling short to someone who's buying after a rally in price. Big mistake, right? You would never walk into a car dealership and say, hey, that $20,000 car, I like it so much, I want to pay you $30,000 for it, right? You would never do that. Don't do it here. So that person's making a big mistake. Mistake number two, they're buying right into a price level where supply exceeds demand, all right? We want to be a seller to that novice buyer. That's how markets work. It's the people that know that get paid from the people that don't. It's really a transfer of accounts, okay? You could buy up to that target, Bill, so long as you found a low-risk entry to do that. I'll look in a second here, okay? Yeah, Rob, you would the same three-step process, just switch the time frames and do the same thing, okay? And Rob, you would do that if you want to reduce the risk a little bit. Of course, you might also reduce the reward, but if you want to bring these black lines a little closer to each other, just do the same thing on smaller time frames, okay? And Victor, yes, if the lines are too wide, meaning your distance from entry to stop is too wide, just ignore that level and move on to another one. That's one of the biggest things one of the most frequently asked questions that I get. And what you have to understand is, out of every 10 levels, supply or demand levels I'll see on a chart, I'll probably ignore 8 of them, right? I'm only looking for low risk, high reward, and high probability opportunity, and that is certainly not offered with every level on a chart. Okay, Jose, great question there, and the answer is it all depends on what kind of profit margin you're looking for, right? Okay, it all depends on what kind of profit margin you're looking for. If you ever been to the racetrack, right? I'm not a big gambler, but if you ever been to the racetrack, I mean, if you have 3 horses that are relatively equal, which one are you going to bet on? You're going to bet on the one that's giving you the best payout, right? Okay. It's the same thing here. Take that same logic into here. All right? That's the beauty of trading. You know, people often compare trading to a casino, and then there's a lot of people that say, "Oh, don't do that. Trading's not gambling." Well, it is. I mean, what's the difference? But I don't want to use gambling in like a negative sense, but it's speculating, right? Think about it. When when Pepsi or Pepsi or Coca-Cola buys commercial time at the Super Bowl, they're putting out a lot of money hoping for a return. There's no guarantee on that return, right? So they're speculating as well. But how about what we do, which is speculating in the markets? This, compare this to how things are run in Las Vegas, right? Imagine being able to sit at the blackjack table and only put your money on the table after you see the cards. And then have the ability at any point to put as much money down as you want, right? Imagine those odds, right? That's what we have here in Vegas. I mean, in trading, all right? The problem is a lot of people don't have discipline, and that's a big issue, okay? Yeah, you don't have to be in the market all the time, all right? The people that have the patience and discipline are the ones who get paid from the people who don't, okay? Jack, a couple more questions here, and then we'll move on. If a supply-demand level gets fully penetrated through a long wick, then you get a reversal signal. Would you take, whoops, let me just see. Would you take the trade, or we're still good? Jack, if price went through a level, I would say that level's no good anymore, because if it was a strong level, it is physically impossible for price to go through it. You know what I mean? So I would go look for the next one. And if you're finding that is happening, too often for you, that means you're simply looking in the middle of the curve. So you want to go further out to the extremes, okay? And so practice what we did on the weekly chart there, okay? All right, let me just, okay. Here's a good example. Someone asked to show an example that wouldn't be good. Well, here's one right here, okay? Here's a rally-based drop. Here's a drop-based rally demand level, okay? Now let me capture the screen. I can't talk here. Pretty early in the morning here in Southern California. I don't live here, though. Okay, so take a look at those two areas right there. So notice rally-based drop supply and demand right here. But in both cases, if we were to draw lines in these, look what happens. Both times, this thing fails miserably, right? I'm just going to draw some lines around that one, some lines around that one. All right. Now notice when price came down to this level. Okay, there we go. You should be able to see it now. So notice that when price came down to, one second, let me fix this. There we go. When price came down to this level here, it blew right through it. Well, it stopped there for a little bit and then fell through it. When price came up to this one, it went through it like it's not even there. So you might look at that and say, well, how does that happen? These are decent levels. Look at how strong price moved down to this level. Well, you need a profit margin. The profit margin is the distance between your two levels, okay? Let me show you. Okay? Because the distance between these two, one of the, we call these things odds enhancers in the extended learning track program at Online Trading Academy. And one of the most important odds enhancers is profit margin. Just because here's the important part. Just because you have a supply level and a demand level does not mean you have a trade. You have to have a significant distance in between these two. Without that is high risk trading. Understand that the greater the distance between your two opposing levels for potential trades around the corner, the greater the distance between these two, your risk reward is becoming much better, and the probability of the trade is also dramatically increasing because you're moving farther away from equilibrium and much farther out on the curve, right? In other words, you're stretching the rubber band more and more. So, okay. So if you start doing this and you start taking every level that shows up, yeah, they're not going to work, and they shouldn't. So here's the thing. Because the risk reward here is not ideal, okay, understand that also hurts the probability of the trade working, okay? Small profit margins are always found around equilibrium. Large profit margins are found out at the extremes. That's why we go through our kind of our three-step process, right? Well, Bill, stick to larger time frames if you want to, but that's not the main point. It's a good point there, but it's not the main point. The main point is whatever time frame you're looking at, make sure there's significant distance in between your levels. And those are the trading opportunities that are likely to work out best. You're right, Rob. Price also stalled in front of that buy level. Yeah, this is a big red flag saying do not buy here if this starts happening right before your level, because that just hurts the profit margin, which it did when price came back into there. AB, that's going to be up to you. So the bigger you make that number, the better. You don't want to make it too big so that you don't get any trades. But you know, I look for at least 3-to-1 to the first target. Okay, and again, I also go over those odds enhancers, so that's important. Jose, do you look at the indexes or confirmation of turns? Typically, I'm using limit orders. Okay. All right. Yeah. So let's get past this and take a look at some other markets. Hopefully, what we've talked about so far is makes sense to you. Keep in mind this little 3-step process that we've talked about. Okay. Doesn't mean you have to use these exact time frames, but make sure you use some kind of combination of time frames like that. Okay. Here is the dollar Canadian. Right. Someone, I think SW, you wanted to look at this one, right? Okay. Aussie Canadian, I'm sorry. Okay, we can pull that one up. No problem. Let me get to it here. All right, SW, I figure since you're typing capital letters, you must really want to look at this market. So let's do it. So again, let's now if you haven't noticed with me in the past, I am extremely mechanical. I'm extremely rule-based. I don't ever stray from my rules. You could put the best strategy in the world in front of me. I am not interested. I do what I do, and it works for me, and I just stick to the rules. So having said that, I'm going to start right with this daily chart here. Okay, and there it is. You should be able to see it. I just recaptured, took the picture of it for you. Okay. So we are in an uptrend on this chart, right? Yeah, Darko, we'll look at as many as we can, given our time here. So here we have the Aussie Canadian on a daily chart. The slope of the moving average is up. No need to say more than that. We're in an uptrend. Step number 1 is done. We're thinking we want to be a buyer. But without looking at the bigger time frame, I don't know how much room this uptrend has left. So I definitely want to see that. Okay? So therefore, let's go larger time frame, the weekly chart. Okay, there it is. Let me capture this for you. Yeah, Jason, I agree. It is nearing some supply. So this is why we use multiple time frame analysis, or I should say, if you are using multiple time frames, this is why it's so important to look at it this way. So that uptrend on the daily looks so good, right? Nice smooth uptrend. Just keep buying pullbacks. However, where does every uptrend end, and where does every downtrend begin? At larger time frame supply, right? Okay. When we come to this weekly chart here, we see that yes, we're in an uptrend, but that uptrend is likely to have to either take a big pause or completely end very soon because of what we have on this weekly chart. Okay? So, again, just the opposite of the market we were just looking at. We can certainly look to buy pullbacks to demand levels, but we probably want to look a little bit lower on the curve. So if we go, to that daily chart to look for levels or something smaller, we want to make sure we're not looking at something too close to current price, because current price on this weekly chart is not that far from that big picture supply level. Okay? Makes sense? All right. Now this time, okay. So now step number 3, let's go to, now first of all, on the larger time or position, let me blow this up for you a little bit. So for traders, and we have many members who take longer term position trades in these markets as well, okay, we may have an opportunity to do that soon in this market for a longer term play. If you remember months ago, we had that in the, we had a nice big long one in the British pound, right? Same scenario here, potentially with the Aussie Canadian, all right? The key is, the chart's telling us when to take that action, and the chart's telling us when to be swing traders, all right? Okay, so let's move that up. All right, so now we know where we're at in the bigger picture. We know what the trend is on the daily chart. Let's now go down to an intraday time frame. And this time, I'll show you a different time frame. Instead of going to the hourly chart, also use one of these time frames, which are really good. Yeah, Jack, I was agreeing with you. There's nothing wrong with taking that short entry at that supply level. Okay, but there's more than one way to play that. If you're a longer-term position trader, you can take it for that. You can also use that level to swing trade against. Even as an active day trader, if prices got up in there, on the smaller time frames, you'd want to sell short, bet to the downside for your day trades also, once you got up into that level. Okay? All right. Yeah. Okay. So now we're looking at the 240-minute chart. Okay? Now let me just first say there is absolutely nothing magical about this 240-minute chart or an hourly chart or a 180-minute chart. This is just a nice, big intraday time frame. Okay? It's a really nice, something like this is a nice time frame to look at. Okay. So remember, we don't want to find any demand levels up here around the 95, 94 area because it's a little too close to that larger time frame supply. So what we want to do is scroll down the price ladder until we find our drop-based rally that is fresh, one that has not been revisited yet. And when we do that, we arrive at this area right here. Okay? So I'm going to put a couple lines in this area. Okay, one there, one right there. I'm going to keep these in, and on our next FX Street sessions, we'll go back and review some of these, okay, that we've looked at here. All right. So now I'm picking a demand level. Number one, that is on the right spot on the curve in the larger time frame. Number two, it's a fresh level, meaning since prices left the level, they have not been back to this area. Okay. All right, and why is that important? Well, understand what these levels, a lot of the books say when you hit a support or resistance level, demand or supply level, don't take the first pullback or the first time it hits that level. And they say that because then they follow up and say, we want to see that level tested a little bit. We want to make sure there's buyers or sellers there. Okay? Well, be careful with that because what the book is really saying is don't take the low risk, high reward, and high probability entry. Wait for the low probability entry, right? And the reason why that is, the reason why we want to focus on that first pullback in price to that level is because this is exactly the same mathematical equation as how you chop down a tree. Not that I like to use that example, but think about it. Every time you take a swing at that tree, you are removing some of the mass from the tree. Okay? Therefore, the tree is more likely to fall. Okay? It's the same thing here. Every time with each pullback into this level, this demand level, some of the buyers that are sitting there, some of the demand gets filled. Therefore, the demand is decreasing, which means your odds are decreasing. Okay? All right. So let's move on here. Yeah, Jason, that's pretty good. That's a pretty strong move. Is there a better demand level, someone's asking, at 93.25? So that'd be up in here. The reason why we wouldn't go with 93.25 is because this whole thing here is rally-based rally, which we're not really in love with because these types of levels are always found by definition. In fact, it's a rally-based rally means it's always going to be in the middle of a move. If you want to trade out at the extremes, we go with the drop-based rally. Okay? Those are our extreme levels. Odds a little bit better there. Janeda, I don't know. I mean, some of the books are, I'm sure that, there's good information in books, but you have to be careful, a lot of people, they keep writing books. What do they spend their time doing? Writing books. So just be careful with that. The best thing that you can do as a trader, and this is my biggest, most important piece of the information here, which actually has nothing to do with our topic, but I'll just say it anyway. The more that you can bring the simple logic of how you buy and sell anything in every other part of your life into the trading world, the better you're going to do. Okay? When you go to the grocery store, most people, are smart shoppers. When you buy a car, when you buy a house, right? In all those scenarios, people try to get a good deal on what they want. In trading, everybody throws that simple logic out the window, and everybody wants to buy after a big rally in price and buy a big breakout. and all those things, right? It doesn't make any sense. For some reason, people throw all simple logic out the window when it comes to the trading markets. They think it's some complicated, fancy mathematical, world, and it's certainly not. Okay. And another question here from Bluesman. Bluesman, you from Chicago? The manner in which price gets to the supply area, choppy or long bars, can affect the way it leaves the supply area. Is this correct? If so, why? Yes, absolutely. Okay. So what he's saying there is the way that price reaches a level, and he didn't say this, but I'll kind of add this to it. The way price reaches a level goes hand in hand with how it leaves level. Let me show you an example. The trade that we took the other day, I'll show you right here. You'll see that's exactly the case. Let me just grab the chart for you. So on the trading session I did for our group on our Sunday session, that led to this trade right here. Take a look at how prices came into the level. Okay, this is that chart. Notice the strong drop in price and almost an equal rally out of that level. That's because within these red candles here, there's really not much to stop a rally in price. So when price came down into our level, it kind of shot right back up, okay? You're going to see that all over the place. And if you look left here, there's just this is a pocket of price action where there's really no supply or demand. That's why you're seeing prices move so quickly through those levels. Okay? All right, let me make sure I'm keeping up with these. Yeah, Rob, I agree. Most books repeat previous books. Yeah, Darko, at some point maybe. We'll see. Maybe when I'm all done trading. Yeah, can we look at the euro? Yeah, well, let's look at another market here. Oh, sorry about that. Hamburger, I was just answering your question there. Yeah, just because just because we have a level doesn't mean it's a level that we want to take a trade at. Remember, we run through this little probability scoring system. I'll try to get into that a little bit more. And what's really good about it is it forces us to ignore these levels like 6,800 and focus on the key levels like this one down here. And that's a lot. That's one of the things that comes up sometimes in the articles, like those lessons from the pros at Online Trading Academy. I know a lot of people read those, and those questions come up from people that read the letters. And my first, one of my first responses to those is, well, yeah, we do have a very specific set of rules, criteria that lead us to the proper levels and force us to ignore the other levels. But those are not things that I think you're ever really going to see in detail in a free trading article. And the main reason is because if I put stuff like that out there, I would get death threats probably from our XLT members. So remember, this is all about having an edge. So if you don't have an edge here, don't compete. All right, let's keep going. So let's take a look at the euro. Again, three-step process. Okay. Gary, it depends which, on the daily chart there, we were very extended from that moving average. And again, that's why, even though, Gary, good point, on the daily chart, it looked like we were in a downtrend. But remember, that downtrend is likely to end and reverse at larger time frame demand. So by knowing that allows us to be in the next trend, as it's starting, as it's beginning, which is way before you'll get your higher highs and higher lows and all that other stuff, right? Euro, in an uptrend. Okay, we see that on the daily chart, step one. I'll take a picture of it for you here. Okay, this will just take a minute because it's very clear, right? Everybody that trades Forex, we see the Euro's in an uptrend. All right, there's a daily chart. When we come to the weekly chart, and let's do that now. Where are we in the bigger picture with regard to supply and demand? There is the weekly chart. Okay, so we see that even though we're in an uptrend, we still have a little ways to go till we get to this, bigger supply level above. All right, I'll just draw some lines in here. So in this market, we could buy pullbacks to levels that are, not all that far from current price if there are significant levels. Okay, if there are levels close to current price, we can look to buy pullbacks to those levels, and we'll take a look in just a second. right? You see how this euro on the weekly is much farther from its big supply level than the others were. Okay. All right. So now let's come down to smaller time frame, and this time let's go to. I'll show you a different time frame, just to show you that what different time frames look like. I don't ever bounce around like this. Once you have your workspace set, the more routine you can be, I think the better. Okay. Now, what's interesting about this euro on a smaller time frame? Let me just take a picture of the chart here. Notice where current price is, 145.55, and notice we're coming into this kind of pocket of nothing here, right? We still have to get through. Price right now is sitting into these prior demand levels. Now we've been here a number of times, so the odds are that this is this area may not hold, right? Because we've been here so many times. And then also too, notice below we've got this pocket of nothing, and as we just saw, prices, if and when they get down to this area, they can tend to move pretty quick through there. So we'd be looking for a demand level a bit lower. All right. But I just noticed the time, and I see that we're about out of time here. So I want to take a minute here to. Okay. Let me just a second here. Let me throw this in here for you. So I just typed my email address in there, sseiden@tradingacademy.com. Okay. All right. There it is, sseiden@tradingacademy.com. If you have any questions, definitely send me an email. And Benny, I did that last Sunday session. That's what I was showing you on the first slide that I showed you. So I do some of the XLT Forex sessions. But thanks for your time. Hopefully that was helpful. And again, if you need more information, email me. Watch those recordings. We're here to help. And for those going to the conference, congrats. It's a great time.